Imagine this. You walk into a bank for a business loan. They say no. Too risky, too much paperwork, regulations won't allow it. But down the street, a quiet fund you've never heard of wires the money in days. Higher interest, sure, but no questions asked. That fund? It's part of something quietly replacing traditional banks. A $2 trillion shadow system that now decides who gets money in the real economy. And most people have no idea it exists. After 2008, governments piled rules on banks. Capital requirements, stress tests, limits on risky lending. Banks got safer, but they also pulled back. Corporations still needed cash. Mid-sized companies, buyouts, infrastructure projects, the kind banks now avoid. So the money didn't disappear. It just moved into the shadows. Enter private credit funds. Run by giants like Blackstone, Apollo, Ares. They raise money from pension funds, insurance companies, wealthy investors. Then they lend directly. No deposits, no heavy regulation, faster decisions, higher yields. It feels efficient, flexible, modern. Here's how it actually works in simple steps. Investors give them capital, often locked in for years. The fund turns around and makes loans to companies that banks won't touch. Those loans are illiquid, hard to sell quickly if things go wrong. To juice returns, many use a little leverage, and they often rely on short-term funding lines from, ironically, the same traditional banks they're competing with. It's like the old banking game, but with lighter rules and longer lockups. Right now, this private credit market sits around $2 trillion in the US alone, and it's still growing fast. In recent years, traditional banks issued their smallest share of corporate loans in over 15 years. The gap? Filled by these shadow lenders. The irony is thick. Banks retreated to play it safe, but now they're indirectly funding the riskier game happening outside their walls. So what's the uncomfortable part? These loans are opaque. Valuations can be subjective. If a bunch of borrowers start struggling at the same time, say in a slowdown, forced selling could ripple fast. Liquidity can dry up overnight, even if there's no classic bank run, because investors can't pull money instantly. And the connections back to regular banks? They're real, through funding lines, collateral, and shared exposures. We're told this system brings efficiency and fills gaps. That may be true. But it also means the power to create and allocate credit has quietly shifted away from heavily supervised institutions into a parallel world with different incentives. Higher returns for some? Potentially higher hidden risks for everyone. The $2 trillion shadow banking system isn't some distant Wall Street experiment. It's already financing chunks of the economy you live in: jobs, projects, growth. The question is, when the next stress test comes, not for the banks, but for the shadows, who actually catches the fall? And will we even see it coming? What do you think? Is this quiet shift making finance more resilient, or just moving the danger somewhere darker? Drop your take below.